we're going to be talking about all these issues here because they all fit into it in some way, shape, or form. Retirement, estate planning, taxes, how you transfer assets. Do you do transfer assets by gifts, sales, maybe leasing, and we'll end up with business organization. And we'll touch on all this because a lot of it falls into the pieces in some way, shape, or form of everything you're going to be thinking about. What is the retirement? There's two key words I have in here. This word is planned or unplanned. My dad is going to retire someday. He just doesn't know when. Your father may be the same point. He will retire someday. We just don't know when. But retirement or withdrawal from the farm business, either in a planned or unplanned method, is going to happen. And they will withdraw from the farm labor managerial roles. Even though we're letting Kyle do all the sweeping now, we've left that responsibility going, but there's still the management thing. But people will withdraw from this at some point in time. It's just the way it works. Okay? Retirement. Have people even thought about what they're going to do with their retirement? And are their plans workable? A lot of people and a lot of older farmers, they don't know what a hobby is. Their hobby is working. My dad's only the last even up to 2 years ago, was still up every morning at 5:30. It's like he milked cows for so many years. He just, even though he hasn't milked cows in over nearly 30 years now, he still has, like, he had to get up at 5 or 5:30 in the morning, eat breakfast, and he'd go back and lay down. It's what he always got up. Now you have the situation, but have people ever thought? He goes, are you going to take things easy? Or are you going to let the kids take over? It's a major thing of what your dreams are. And then a timetable. When is this going to take place? Well, I guess whenever I feel like it's ready. Well, the thing that brings a lot of farmers thinking about retirement a little bit is when they go sign up for Social Security. That's about the only time that they start thinking about, and then they might have to make some adjustments for their Social Security income. There's other questions to think about. Where are you going to live? Where are you going to live? What sources of income going to be in? Healthcare. Healthcare gets to be a major issue. What if somebody has to go into a nursing home? Does that mean they're going to have to sell the farm to get there? Are they going to have to sell the farm to pay for it? Who's going to be who's even going to be taking care of it? So will this residence be on or off the farm? A lot of times I like to tell things that if the younger generation is going to take over the farm, let them move into the farmhouse so they're where the center of the activities are. Mom and Dad, if they really want to withdraw away from the farm, need to move away a little bit and out of sight of the kid's house. So they don't see when the lights go out and when they're going to bed. You realize those kids, they're up till 10:30, 11 o'clock every night. My goodness. And they must go out to eat once a week? Why? Oh, outrageous lifestyles. But then there's also another thing to think about. My cousin of my mother's, they farmed near their, they had 3 boys and a daughter. The oldest son bought a farm close to their home farm, and then another son, second son, rented a farm close to where Mom and Dad were, and they all worked together. And they used Dad's machinery, and that helped the younger men get started. And normal activities in the morning, like on a day like this, usually the 2 sons would come over and see what Dad's doing, and they'd come in and have coffee in Mom's house. And they'd go out and they'd be working together where needed or doing things at their own places. As Dad got to be 67, he decided it was time to hang up, and his youngest son at that time drove truck, and he told Dad, he goes, when you're ready to retire, I'd like to buy the cows from you. I'd like to farm rather than be driving all over the countryside. So Dad said, okay, it's about time. And so he sold the cows and machinery to his youngest son, and he was going to rent him the farm. And so he and his wife moved into a house and bought a house in a small village about 3 miles away from the farm. So son number 3 is on the farm, son number 2 and son number one are all farming. Well, the first morning that they spent the night in town, next morning, 6 o'clock, Dad's in the pickup and out to the farm. He comes back at 8:30, eats a quick breakfast, back out, and he eats lunch out with one of the boys, gets back home, he comes home about 5:30, and this is their new lifestyle now. Guess what? Mom used to be at the center of activity. She kept the books for the farm. All her sons would come in for coffee in the morning. The grandkids got off at her house in the afternoon. Where is she now? She's back here in the village, and all the farm activities are going out here. She had a major withdrawal problem. No one really thought what she was going to be doing. Dad was still out there floating around doing the work and doing what he liked to do, but she had a major problem. So you need to think about what person is going to be doing, because there's another side to this and other multiple people involved in that situation. Okay, retirement income. How much do you need? Generally, we're seeing today that people need up to $40,000 to $50,000 cash to live in a year. Factor in life expectancy. How much will you need in 10 years? If you have 3% inflation, you're going to need $60,000 in 10 years. You're going to need nearly $80,000 in 20 years. Where's that going to come from? Ooh, never thought about that. That's one of the problems with people living longer, is they need more money to live off of. And where's this income going to come from? Social Security. Okay? Now, people will deny this to their death, but I try to reveal this to people, and I haven't been killed yet. But have you ever taken the farmer's oath? She'll deny it. The farmer's oath goes like this. On the blood of my grandchildren, I will swear that I will never pay more than $1 extra in taxes than what I have to. I will do everything I can to buy equipment and depreciate it. I will use investment tax credit. I will do everything I can to show a loss on my Schedule F so I do not pay any tax, nor do I pay Social Security tax, so that at age 65, I don't collect much in Social Security. Now, I know you guys are going to deny it because the Farmers Guild has threatened you or grandchildren, but farmers spend a lifetime of trying to avoid taxes, and then when they turn 65, they find out they only get the minimum for Social Security. You're shaking your head. Does that seem right?
Very much.
Really? That confirms it. Okay, investments. Most farmers, where do they invest in? Well, while they're trying to avoid taxes, they invest in machinery and equipment and land, but whenever they get to retirement, all their money is invested in machinery, livestock, and farm assets, and these are not generating much income, and now that creates a problem for where is there going to be the cash coming from, and they should have been maybe making diversification, maybe completing some IRAs, stocks, or savings. If they were smart, they sent their spouse to work off the farm so that they work for like the State Department of Agriculture, and they get a pension, and they get some retirement benefits. And health benefits. The health benefits are crucial. Crucial. Other farm income and assets, but it usually may have to come from selling the assets. So all too often we have this is retirement planning for most farmers or people in town. They haven't saved a dime. They have a lot of farm assets, and it's really incredible when you sit down with a couple people that are concerned about estate taxes because the government real estate evaluators tell them that they're millionaires, and they're sitting there with jeans with patches on and plaid shirts, and one of their wives say, well, I'd like to have a little extra cash because we can't get our porch roof fixed. It's leaking. We have a lot of situations like that. So, how much do you need while you're still here? Well, you need at least 80 to 90% of your current income is what people generally say. We don't really cut back that much when our standard of living whenever we retire. Factor in that life expectancy, and then you have to question, where's that money going to come from? Okay, we also have this volatile markets. Does anybody in this room remember what happened in September of 2008?
Was that when the market crashed?
Yeah. Is there anyone here that has an IRA or retirement account? What happened to it? You know, you back, yeah. If you back, but boy, that feeling in October, he goes, you went and you got that statement and you went in and you flushed the commode. He goes, there's your retirement going down the drain. Okay. This is a tough thing. But you should still remain diversified and not put, by investing some money off the farm and still providing some assets. And it gives a lot of flexibility then, because when you're dealing with a farm family that has some off-farm income and they have a pension from a spouse that worked off the farm and they've had some other investments, with Social Security, they are in a more flexible situation of getting that farm over to the next generation because they don't have to have all their income coming from the farm again. But expect ups and downs in the market. Okay, farm income. A lot of farmers don't want to stop farming, so they may continue as being the owner, but might be more likely as a partner, or maybe the ones that really step out of the management role will let the younger generation take over the management of the farm, and they'll continue as a laborer. They can rent the farmland, and they can sell the farm property. But there's tax implications here. Here's one implication that can cause some problems whenever you rent the farmland. The IRS has this rule called materially involved. Material participation. Means that if I'm going to rent Kyle the farm, but I keep coming down every day and I'm helping every day, am I materially involved in the farm? Well, the IRS would say that I'm materially participating, and therefore the money that Kyle is paying me for rent is really not rental income, which isn't subject to Social Security tax. It's actually earned income, and now it's subject to Social Security tax. But we know a lot of farmers do that. They rent the farm, they sell, maybe sell you the cows and equipment, and I come to work for you, but he's still there as often as he was before. That can be dangerous if in case of an audit turns up and there's a determination that the father is, or the parent is materially involved with the farm. But one of the big things is, can you afford to pay me? You have to be generating enough income to pay for my labor. Besides, you can't fire your father, can you? No. And then we have our family relationships. Can the children work together? Will they help with household needs if you're getting into retirement? And be careful about this one. Be kind to your kids, because they're going to be the ones picking your nursing home. So don't get too mean with them. Okay, the flip side of the retirement income is, what is the younger generation going to live off of? If you're transferring the farm business, they have to have money to live off of too. So I'm going to sell you the cows and machinery, I'm going to work for you, and you start figuring out, he goes, wait a minute, I don't have any money for myself. That system is not going to work. There has to be a realization of what the younger generation is going to live off of. Peanuts, poverty wages, they can't live off of, someday this is going to be yours. That promise doesn't go too far. And all too often, you have the younger generation working for less than half of what they could if they worked off the farm, and they're dependent upon a spouse that they marry that is actually bringing them health benefits and their cash income coming in. Why are you trying to build a business that can't afford to pay the labor needs of the people that are working there? Something needs to change on the farm business. How much for the income? Well, I guess if you're still living with mom and dad after you come home from college, you could probably get by on $20,000. But if they get married, you're going to start needing more cash. And they start a family, oh my goodness, they went and they had kids already. Now they need health insurance. Then what happens worse yet, whenever the children's spouse gets pregnant, she quits her job because they're now dealing with the thing. Child care costs, if they have 2 kids, they don't make enough at work to pay for child care for 2 kids, unless grandma's keeping the kids. So how are they ever going to move into the owner position? They can work into it, but they're never going to be able to buy their way into it because they're not making enough income. So this is, we're getting into thinking about all this of where the money has to flow. A farm service agency director from one of the western states at one of our training sessions one time, he goes, after 30 years of being in it, he goes, I think I can identify 3 crucial things that helps a young farm family get started. He said, 1, they have to have assistance from the parents or the in-laws to help them either with equipment or access to land and help them get started into a business. 2, you have to have a spouse that is employed in a job in the local area, and in most rural areas, the best 2 places to have is either teaching or nursing. 3, there's a mother or mother-in-law that's willing to keep their kids. He said if they have those 3 ingredients, they have a great chance to get started farming. You keep shaking your head. Have you heard this stuff before?
All the time.
Do you agree with that observation? Yeah. And that's very crucial for somebody to get started in the farming. And we have young people that want to get started in the farming today, and then you ask them, what are you going to live off of? I teach a course in ag policy at the University of Vermont, and most of them are environmental science majors, and a couple people want to get into farming and grow vegetables. I go, how much money do you need to live off of? Oh, not much. Well, what's your profit margin going to be? I don't know. Well, then how much do you know how much you need to sell? If you want to make $25,000 and you want to let's use 10% because that's the math that most students can handle. He goes, if your profit margin's 10%, that means you have to sell $250,000 worth of vegetables. And they go, well, I'll do that at farm markets. Okay, how many farm markets are you going to sell at? And he goes, and if you're going to sell them halfway through the year, let's figure that you can do 20 farmer markets. All of a sudden you're going to have to start seeing them. How much, you need to make $10,000 worth of sales from each of your markets? That's almost impossible. Okay, come back to reality, folks. Let's stop and think of what we're going to do. And a lot of times if you work from the bottom up, how do I achieve the income that I need to get? It depends. Then you start dictating what level sales and what level of farm operation you have to have. It starts getting some gears turning in here and saying, how the hell am I ever going to do all that? Let's get in this. What is estate planning? Estate planning is what is going to happen to your assets after you're gone. And can I control them while I'm here? I want to take care of myself and my loved ones. I want to give what I want to whom I want, when I want, and how I want. And you want to do so with the possible lowest cost and fees available. If I can do it without paying any legal fees, I'd love to. But we end up having to pay some legal fees because that's how we have to do it. And one of the things it does, see this word up here, it says planning. What happens if you don't plan? If you don't plan, you are actually making a plan to not have an estate plan, and these things will not happen. Okay, what's in your estate? Everything you own, real estate, farm machinery, other business assets, vegetable crates, your cash, stocks, bonds, personal items, anything of value. These are the things that are in your estate that you will be responsible, or you can give away or sell or leave behind, unless you can take them with you. And we just haven't found out too many ways to do that yet. Business assets, of course, the most valuable one is the farmland. You have the equipment. Well, it can be worth something. Vehicles, inventories, even goodwill, which is pretty hard to value, but it might be value if you have an ongoing business. Things like your life insurance, any annuities you have, revocable trusts, anything that has value that you can assign to somebody is an asset. Then you run into some things with jointly owned property. What if the business is incorporated or an LLC? The value that is in your estate is the value of your share of the business. If you own a third of the LLC or a third of the corporation, property that is owned with the spouse, yours. Now there might be some cash that grandpa has stored away. That's not part of the estate if you don't report it. But of course it depends on who finds it then. But if it's locked in a money security box in a bank, it will be accounted for. Of course, there's some people always try to keep some things out of the estate, but sometimes you find about these stories of people selling something at a yard sale and it's got $10,000 hidden in it or something. Anyway, how do you value these assets? Well, most of our assets are going to be valued at fair market value. That's a problem with farmland because it can have pretty damn high fair market value for used for other purposes. You may have an agreement within an LLC that can restrict the value of the property. If you're in a business agreement of an LLC that restricts ownership to direct descendants of the original owners, the IRS will generally recognize a reduced value in that because it has very few options of people buying it. Conservation easements can help reduce the land values. Goodwill, again, it's very difficult to even value that. And for most problems with, whenever someone dies, it's important to have, when you set the value, to be able to document it. Have an outside evaluator come in and evaluate the business. Your value of your real estate is the value of it, its value, less the debts against it. Today, the estate taxes are set at $5 million. And it's set up with inflation now, so that it's going to be going forward adjusting for inflation each year. But if it's more than $5 million, Uncle Sam wants to hear from you. Uncle Sam needs lots of money these days. Things aren't going so good down there. They have to keep printing more money, so he needs all the money he can get. You can put in restrictive ownership clauses and maybe on real estate. That can reduce the value. You can gift your assets, and that should be before death rather than debt. If you get rid of assets, you can gift them. That'll get you down under the $5 million. Consider annuities or insurance that is payable to the spouse or to a trust rather than to the estate. Or you can sell or gift assets that are likely to increase in value. This is where the farmland comes in, because the farmland keeps going up in value, and it may not be worth $5 million today, but it might be in 5 years. So maybe that's the type of asset that should be gifted off, whereas the equipment might be a lower value. But all too often, our estate planning results in this. Our attorney's happy, our CPA's happy, and the Uncle Sam's happy. And this is where the failing to plan comes in. Okay, what is a will? A will is the most common document that people use to transfer ownership. And it only transfers property that you own at death. It's ineffective for jointly owned property. And it does require probate, which means it goes through public court after death, and so everybody gets to know what you own and everything. And here's the thing. Is there anyone here that doesn't have a will? Yes, you do. You do have one too. Did you know that? Did you know you have a will? New Jersey has a will for you. New Jersey has a will. In case you don't have a will, New Jersey has one for you. Do you like New Jersey's will?
Probably not.
Then if you want to change it, it's up to you to make up the will. If you don't have a will, New Jersey, whatever state you're in, has one for you. So you don't die without a will. But unfortunately, 80% of the people still die without wills. Many wills were made out a generation ago. So most wills need to be looked at least maybe every 5 years. They should be looked at whenever there's a major change in the family. Have your children got to be older? They don't need trustees anymore. You've gone through a divorce. You've gone through a death in the family. You've gotten some recent inheritance. A woman that works in our department, I was talking to her a little bit, and She just inherited $500,000 from her mother who just passed away. And I said, now have you updated your will? She goes, no. And I go, well, do you know what would happen to you if you got killed in a car accident today? I guess it would all go to my daughter, who's 18 years old. He goes, do you want her to have $500,000? She goes, I don't think so. And so, she went home that night and typed an amendment and added to her will, naming her brother as trustee and that her daughter can't touch this money until she's age 30. You don't want to give $500,000 to a 18-year-old. But her greatest chance of passing away would be in an auto accident. So you need to, times like that, you need to have that updated will. Now, wills don't help out much whenever you're physically incapacitated. And if you don't know what's in your will, go find out. Okay. Now, how do you treat your off-farm heirs in your will? Boy, this is the biggest dilemma most farmers have. Equal is the easiest thing to do. We're going to split the farm up between you and your 10 brothers and sisters. Wow. You're still on the farm, you get 10%. You've been there all your life. Is that fair? I don't, but that's what the parents have to determine. Equal is seldom ever fair. Now, if we split the farmland up, it kills the farm business. That's a major step that people need to consider, because what is the business that's being done on that farm right now, and does it require access to all the land that's on the farm? And if it does, anything that you do that splits up the farmland is probably going to kill that business. You might as well just take a gun and go bam. We just killed the business. We took the resource away that the farm business needs to operate. Aware of other things. Land titles, life insurance, retirement accounts have a designated beneficiary. Land titles. If the land is titled joint tenancy with right of survivorship, it doesn't say if I put in my will, the farm goes to Kyle. But if I own it with someone else and it's joint tenancy with right of survivorship, the land doesn't go to Kyle. It goes to maybe my wife that I own it, my second wife that I own it with. So know how your real estate is titled. Here's another thing that can happen. I get married. Get my wife, and she says we need a life insurance policy. I take out a life insurance policy. She realizes how much of a bum I am, kicks me out. I go and find another wife that I can fool, and I talk her into marrying me. And she kicks me out, and I go marry a third wife. And then the third wife finally, instead of kicking me out, cuts my brake lines, and I die accidentally in an auto accident. Then the third wife says, oh boy, I finally get his life insurance. Because right in the will it says I leave my life insurance to my wife. Only she finds out that whenever I bought that life insurance, I designated my first wife as the beneficiary, and I never went back and changed that. So who gets the life insurance? First wife, not the one who cut the brake line. The idea of the story is, if you aren't sure who your designated beneficiaries are on life insurance and your retirement accounts, check with whoever's holding those and make sure that those are up to date. You might have signed over to a daughter. A lot of people, when they're young, they designate their parents as their beneficiaries of their life insurance because you don't have a spouse or kids. You get married, and you kick the bucket, and your wife now finds out that your parents get your life insurance. Is that what you really want? But the big thing on this is knowing that these things of land titles, life insurance, retirement accounts that have a designated beneficiary, they are not controlled by the will. You have a designated beneficiary where you've identified someone and given a tax number. That's who gets that insurance. That's who gets that retirement account. That's who gets that life insurance. And if you don't know who is getting your life insurance and stuff like that because it's been a while since you've designated that, you better do it. One thing that we're seeing a lot more of today is trusts. Trust, a revocable trust, is something that you create. It's a legal entity set apart, and it makes it possible to control your assets after death. And it facilitates provision of your care in case you become incapacitated. You are the grantor. You put your cash and other assets into a organization that you've created, a legal entity, which is called your trust. And you name a trustee who manages those assets. In many cases, it can be yourself. But you can also designate that in case that I am not able to manage the trust, I name Kyle to be the trustee, or I name someone else to be the trustee. Now, in the dictates of there, in case that I die, I'm going to say that the beneficiary of my trust is my kids. And they get to receive the benefits of the trust, of the income. And what I'm going to say is, whenever the last one of my kids gets to be age 25, then the trust is to be dissolved and it's being divided up among all my children. So I've now set a trust up and I've decided how it should be done, and I have a trustee to manage the trust. I can also leave some terms in there that in case I'm incapacitated, Kyle will manage the trust. He has the authority to make decisions about my assets. In case I have a stroke or for other reasons I cannot make decisions. So we have a lot of people now putting their assets into trusts with this idea of having a trustee management. Now, one of the advantages of a trust is it doesn't go through probate. And it's not made public. The disadvantage of a trust is, are you trustworthy? I didn't get a yes. You're putting a lot of responsibility on who that trustee is. We're getting more with trusts. Now, how is the trust? Trust is a private document. It's efficient, can be a little bit more efficient, less likely to be contested. And they can be useful with dealing with taxes and carryover basis. And it still needs to be used with a will because you may still have some assets that are outside the will, like personal household assets or something like that. So you can still have a will that just cleans up anything that isn't in the trust. Now, there is another revocable will trust, so they enable control of your assets while you're alive and even control of your assets after you're gone. How you want them controlled during your lifetime, at death, and after death. Now, it also can facilitate the provision of creditor-predator protection, keeping things from a spendthrift in-law, and for care of children that have special needs or for your incapacity. There's what I call snake oil charlatans out there selling trusts. And they call people and say, would you like to have a trust? We can set one up for you and it will save you probate and taxes. You tell people they'll save on estate taxes and they're just ready to jump on anything. And they set up a trust for you. You now have a trust. Great. But these people move on. You never hear from them again. And so I've run into people that have a trust. But it was never funded. What does funded mean? If you have a trust and you want to put your assets into the trust, you have to retitle your assets. Meaning you want to put your home into the trust, you have to go down and change the deed from Bob Parsons to Bob Parsons' Revocable Trust. And if you don't do that, that asset's not in the trust. The trust only controls the assets that are in it. And that means you have to, your bank account has to change from Bob Parsons to Bob Parsons Trust. So you have to put assets in the trust. So if you ever get a phone call from somebody that wants to sell you a trust, hang up on them and run. Don't do anything with them. You want to do this with a competent attorney that you know what you're doing and is going to be there tomorrow and is going to walk you through the entire process of retitling your assets so they're in the trust. Okay, other health planning documents you need to keep aware of. We've got healthcare agent who's going to make your decisions for you in case you can't make your decisions, or you can sign that whenever your father needs, whenever you need to. But a lot of people like to do it a little bit ahead of when they need to. You should have a little living will for terminal illness. When do you want someone to remove the plug? Do you want organ donation? These things should be put in your documents. They should always be completed by an attorney who's familiar with the laws of the state that you're in. There is stuff that's educational that you can go out and pull off the internet for helping write a will or writing some of these health directives. They should always, you can do that and you can make a lot of your decisions, but you should always have the final document prepared by an attorney that's familiar with the laws within that state. I'm not trying to get you to spend money on attorneys, but to be 100% sure, you need to be talking to somebody that is competent of the laws within the state. Now, taxes. How many people here are in favor of taxes? How many people are in favor of your neighbor paying more taxes than you do? That's what most people are in favor of taxes. We want to let the other guy pay them. Well, here's the estate tax story. In 2010, the estate tax expired. There was no estate tax in 2010. Then in 2011, the law reverted back to 2001. But later in 2011, Congress passed a new law that backdated to January 1st of 2011, and it expired in 12/31, giving a $5 million exemption for personal assets for estate taxes. And then on that late night, New Year's night or New Year's Eve, whenever Congress finally passed one of their recent bills, they extended the estate tax law, only instead of making it just for 1 year or 2 years, they finally have set it with a $5 million exemption. It's tied to inflation, so they don't have to come back and readjust it every year. Because it seems like during the past couple of years, people say Congress wasn't concerned about anyone. Well, they sure seem to be concerned about tax attorneys and tax accountants, because everyone didn't know what to do with their, what do you do whenever you have a situation that, a year ago, that your estate, if it's worth $5 million, would not be subject to estate taxes, but if you died on January 1st and the law reverted back to $1 million, you might lose all of it to estate taxes. Well, they finally got past the estate attorneys and accountants, and now we have it set at $5 million, and it's set with inflation, so we're not going to be looking at the situation where it's going to be changing every 2 or 3 years with the whims of Congress. Mom gives you the farm. If she gives you the farm, she gives you also her basis in the farm. So you own the farm now, but your basis is $100,000, which was her basis, which she paid for it. Now you turn around and sell the farm to Lori. Now your capital gains are $900,000.
Okay.
So you have to pay the $180,000. So what would you rather have, Kyle? Would you rather have your mother give you the farm, or would you rather inherit the farm?
Inherit it.
Okay, watch your brake grinding on the way home. I say, and your dad died. And if they owned it jointly, his basis was $50,000 because he owned half, and your mother's basis was $50,000 because she owned half. Now, she gets a step up in basis of what she inherits from your dad, so half of that would come to her at a basis of $500,000. Her basis is still $50,000 on that part, whereas if now she gave it to you, you would have a step up basis on half of it, but you're still, the ultimate is you're better off to inherit the property rather than to have them give it to you.
But I guess my point was it's important to get an appraisal at the time
Oh, yes.
of the one spouse is passing away.
Yeah. Well, it's always because when the first spouse passed away, it's good to have the appraisal because they have to go through probate of the will at that time. But the bottom line is here is that you would much rather inherit the property rather than having the property gifted to you. That's the bottom line on this. But that makes the problem then is, while you would like to get this step up in basis, you're still dealing with your grandfather who's in his 80s and is still out running marathons, and you're wondering, how long do I have to wait to get the property? So I just went over the property basis. It's really important because you get this step up in basis. Okay, step up in basis for inheritance. Again, if the land's purchased for $50,000, that's the basis. If the market is value now is $500,000, the person that inherits the property gets a step up in basis. Huge, huge importance. Now, here's something that people can do if you have $10 million worth of assets. And here's what normally happens. If the husband kicks the bucket, his $5 million assets goes over to his wife, and now his wife has $10 million worth of assets, and she's subject to estate taxes. So if she would die, I need to change those dates, but she would end up owing about nearly $2 million in estate taxes. Now, how can you change that? There's $5 million for everybody that passes away. Well, if we separate the assets, so whenever the husband passes away, his assets go into a trust. It's called a bypass trust or a couple other names. And what this is, the property is evaluated, say $5 million, okay, it's right on the line, so therefore there's no estate tax. But he puts it into a trust. He doesn't give it to his wife, but he allows his wife to be the beneficiary of the trust. She gets all the income from it. She gets to use those assets. And the provision of this trust is that upon the death of his wife, the assets are divided to his children. So that's the lifetime of the trust. The wife dies in 2012, and what ends up happening there is her assets are valued at $5 million, so whoops, no tax there. So her assets all go to the children with no federal tax. Since mom passed away, the trust is dissolved now. That goes to the children. And so that, simply by dividing the assets, you can get a double whammy on your taxes. And so what there's a $5 million exclusion for every person, not just the joint estate. Now, that's good if you have $10 million worth of assets. I don't have $10 million worth of assets, so I don't have to worry about it. But if you own a lot of farmland that has a potential commercial value, you can easily get up over that $5 million very easily. Okay, whoops, we got New Jersey taxes too. And I was a little surprised when I made this slide up. New Jersey has a tax on estates over anything over $675,000. And they're taxed at a progressive rate, meaning the bigger the estate, the more tax you're going to pay. They also have an inheritance tax. I never knew this one. So unless you're a close relative, which I take to being a child or a parent, I mean, you have to be directly, very closely related, there's also an inheritance tax. So I don't know what the level percentage these are, but this is, whenever you start talking, most people generally talk about estate taxes at the federal level, which start out at a very high percentage, 35 to 40%. Most of the state taxes are probably more likely about 6 to 10%, I would guess, but I'm not sure exactly. But if you have an estate worth $4 million, just don't start celebrating and clicking your heels yet because you didn't have any federal tax to pay. You still may have some state estate tax and inheritance taxes that at even a level of 6% can be very substantial. So you could have, let's say you had $1.2 million of estate tax, you have $1.2 million of estate, what ends up happening here is, let's take a look at the different numbers. If you had $1.2 million estate in the state of New Jersey, and the husband died and he left all his share to his wife, then his wife would be subject to estate taxes. By splitting it up this way, you could avoid the New Jersey estate tax even if it was you have an estate under $5 million.
And 1.2 million in New Jersey is quite common.
Yeah. It doesn't take much. I mean, you take a real estate that's worth $500,000 and you throw a retirement account and some other things in, and you throw in some farmland. I mean, how much farmland does it take to be worth $1 million in the state? Now, where you run into some problems doing that is, but if you own the property back in New Jersey, you still probably have to pay, you have to file probate in 2 states. And a lot of times people say, like, I know the attorneys in Vermont make the recommendation is that if you own a house in Florida, put it in the name of an LLC, because the LLC doesn't die. And so the property, and then if you pass away in Vermont and you're a resident of Vermont, you don't have to file probate and pay 2 lawyers in 2 different states to do your thing, and you have no problem transferring because the house in Florida is in the name of the Bob Parsons LLC, and that's regulated within the LLC, not within the estate laws. So we get into, did I get there? Yeah, okay, we're past New Jersey. Capital gains tax. I explained that here. Anytime you have a gain, you have capital gains tax. So this kicks in if you're selling something. So if you're going to sell your assets, even to your son or daughter or other family members, if particularly farmland because it has gone up in price so much, you end up with a high tax. You can end up with a substantial capital gains tax. Do you know that there are farmers out there that are technically bankrupt? Do you know what technically bankrupt would be? There are farmers out there that if they calculated what their potential capital gains tax was if they were to sell out, plus what they owed on the property, they'd be bankrupt. They can't stop farming because if they were to go out of business, they wouldn't have enough money to pay off the government and taxes as well as their lenders. So they keep farming. They're just going to keep farming until all their equity is gone. And that is in existence out there. We have farmers that are technically bankrupt. Issues with capital gains. When you buy land, you have, and keep it 30 years, you have a low basis. That's the bottom line on capital gains tax. Now, earned income tax. If you decide to keep working after you retire, you still have to pay Social Security tax. And if you're self-employed, you get to pay both halves of it, so you're 15.3%. So a lot of times, a lot of the efforts that we try to get to is a lot of farmers will try to transfer some of the assets to the younger generation and charge a rental income for the assets and try to get around the materially involvement issue and try to have their income come in as rental income so they don't have to pay Social Security tax. That's where you get into some things, because if you're a custom operators in Pennsylvania are technically supposed to have a license plate on their tractors, but very few of them do. And to get a license plate, you have to pay sales tax. That's why a lot of times you'll see a lot of people that own a small individual that owns a backhoe. If he's running it on the road, he hopes he doesn't get stopped because he's supposed to have a license plate on his piece of equipment, and he doesn't have one. And to get one, he'd have to pay sales tax on his equipment. There was a case over in, Franklin County a couple years ago, with a custom operator that got stopped. He was custom manure hauler. And he was stopped by the police, and because he was doing custom work, and I'm not sure whatever came of that because Farm Bureau got into it. And what the problem was here, there was a guy, a competitor reported him to the police because his competitor used trucks. And he had to have license plates for his trucks. But this guy was hauling with four-wheel drive tractors. And he said, well, what's the difference between my using trucks and him using tractors? Because he wasn't paying license for his stuff. Gets into a really ornery thing here. Okay, gift taxes. You can gift up to $5 million to anybody once in a lifetime, but what that does is that offsets your exclusion whenever you come in for inheritance taxes. So you get $5 million to either use as a deduction for your estate taxes, or you can make a $5 million gift up to anyone. Now, you can give away up to $13,000 to as many people as often as you want. Well, once a year. Yes, young lady.
14,000 now.
It's 14,000 now? Okay, it's pegged to inflation, so it's going up. Okay, but you can make, I could gift everybody in this room $14,000 every year.
We'll take it.
The checks will bounce.
The checks will bounce.
But it is a way to, if you want to gift farm equipment or some livestock or some other type of farm assets to a son and daughter-in-law or to a daughter and son-in-law, because mom can give $14,000, $28,000, dad can give $28,000, they can give off $56,000 worth at one time. So it is a way to gift over the cattle equipment, other type of equipment. And if there is any tax involved, the taxes are paid by the gifter, not by the giftee. Okay, so how do we transfer our farm assets? Inheritance. Okay, like we said before, inheritance works good because the owner gets to hold it for as long as they live. The advantage is they can always change their decision. And then the receiver receives stepped up value. From the gifter's point of view, I get to control it until I'm dead. Well, that gives me full control. Well, the disadvantages is you have to wait until the owner is ready to retire. And in many cases, what we have whenever the boys are 60 or the mother's 60, I mean, you have to wait until they retire. And depending on the ownership, that may not control much of your property. And if the land is continuing to escalate in value, you may not have anticipated it, but land that's worth $4 million a day is not subject to estate taxes, but it may go up faster than the inflation rate and be subject to inheritance taxes in a few years. And so inflation really compounds the issue of estate planning. There is another issue involved with this. If Kyle is running the farm and he wants to recapitalize, he wants to build another sales room on the barn or on the farm, or a processing plant for packing vegetables for what he's selling out. How does he go get a loan? You go to the bank, get a loan. You have the cash flow to pay it off. But what loan is going to give him money to put a building on land that is still owned by mom, or worse yet, by grandfather? It really hinders the expansion and recapitalization of those that are involved with the business because of that whole aspect. So that makes things there. So I've gone over this with the step up in basis. That's an important point to keep in mind. Gifting. Gifting is really great. You part with the property, you give up control over it. You can give assets, or you can give a cash gift to as many people as you want. $5 million or $14,000 per year. Well, that sounds good. Advantages of gifting: you can reduce the taxable estate of the gifter. If you've got over a $5.2 million estate, give away $300,000 of it, and you have your estate now under the $5 million. You also transfer the tax obligations. We give the farm to Kyle, he's subject to the capital gains tax, but he's still got the farm. Somebody still gave you $1 million farm, you can't kick at that. And so it's a helpful way for young farmers to acquire assets, including equipment or some of the operating business. Disadvantages: Can't be conditional. What if you want to get the gift back? A gift is given. You no longer control that asset. You know, I mean, if I give somebody some money, once I've given them the money, I can sit there and I can complain about it, but they don't have to listen to me. And so you also receive the donor's basis, which makes it a little bit. And also, if someone's gifting something like a property or a truck or something that has a title to it, you can give the gift, but you also have to transfer the title to it. You also have to be careful about giving a gift that the person really owns. I took a loan out on I used my cattle for my collateral for my loan. I'm going to give you 5 cows. Can I give him 5 cows? No. They're really not mine to give because someone has a lien on those cows. Well, people do generally give away cows because, you know, they can disappear real easily. They're kind of mobile. You know, you can get them on a trailer at night and they can disappear. But land is pretty hard to move. You know, it's like the people that try to take it with them. You can't do that. Okay, so that gets to be problematic. Sale, why don't we just sell the farm? That's the easiest way to do things. We put the position, we're going to do an installment sale. Grandpa or mom's going to sell you the farm. They're going to give it to you over a 30-year, and so what they're actually doing is they're the mortgage holder, and they get to report the income and the interest over several years. It provides the buyer with a source of credit, so you're credit worthy, but the seller is in risk of default or repossession. In the case of farmland, it's probably not that much of a risk, but for an elderly person, they don't want to go through that process. And they may not like that aspect. But the buyer now owns and controls the assets. But this is something that a lot of families do, and a number of them do them in created ways to help the farm family out. What about a bargain sale? The farm's worth $1 million, we're just going to sell it to Kyle for $100,000.
Those $1 sales that you see.
They are $1. Can you afford a $1 easier than $100,000?
For sure.
For sure. You can come up with the dollar, okay? There, I'll even loan you 35 cents to make the dollar purchase, okay? Now, this thing has tax implications all over it because it's primarily a gift as perceived by the IRS. So, don't do this without first consulting your tax accountant. Don't even think of even trying to do this without talking to your tax accountant. There's a lot of stuff in here you need to talk to a tax accountant before you even think of starting to do. How about conservation easements, meaning selling the development rights? Is that a great way to get the value off the farm? People sell the development rights, okay? Most of them are for forever. Forever can be a long time. Do you really want to trade decision making on the farm forever? But it can help provide some retirement income. There's also, don't forget about tax liability because you're going to have capital gains tax to pay on the proceeds. Working with an accountant again, the lender also may want some proceeds of that because you just sold their collateral. So what's going to be left over? So it's important to negotiate the first future possibility of use. You only have one chance to do that negotiation because once you've signed it, you have to worry about it. In New England, we've had some problems with cell towers. People sell their development rights, and 5 years later, some cell phone company come in and said, you have a nice silo there on top of a hill. We'll put a cell phone tower in it. Land Trust says no, because that land can only be used for ag purposes. We got a small problem, folks. Okay, flexibility and use of buildings. Can you build a future building? Can you build labor housing there for farm labor if you need that? What about, do you want to preserve a couple lots to maybe allow some family members to build a house? Those are the things to think about in these negotiations, because once you sign the negotiation, you're not going to be able to go back and change that very easily. Leases. We can use leases. We can lease the equipment to someone. It's the same as like rental income to the leasing the equipment. And a lot of times you might be leasing some depreciated equipment. What you can do is you rent the equipment to the kids. The kids pay a cash amount that comes back to the farm, back to the parents. The parents then can depreciate the equipment down until it's down to zero. When it gets down to a zero basis, then you just gift it to the kids. That's a good way to do that. It transfers assets, but not the ownership, but it does allow the farm kids to get ownership of it then, work into that. It can be used for land, buildings, equipment, livestock. And it's a good tool to use prior to actually gaining ownership, but they can work into ownership through this gifting and leasing arrangement. Allowing a lease to a new farmer. There's some things that you may want to be sure of. It allows the leasee that's renting the property firm control of the land for years. You want the lease to accommodate for building structures. Whenever you're renting, a lot of leases are done with families on a verbal basis, I suppose with families, because they're not likely to take each other to court. People just don't sue their mother and father or their kids, but it does happen. But if you're having somebody else outside and you're writing a lease, have somebody look at that lease to make sure that it meets the needs of the people. You need to have so many things. I had a case where somebody up in central Pennsylvania where I was, a young man rented some property for several years and he signed multi-year leases. At the end of the second year, he went bankrupt. He was in reorganization. Guy goes, well, I guess he won't be farming my land next year. And he told that to the farmer and he goes, yes, I am. And within a couple of days, the guy got a letter from his lawyer. He's in reorganization. He's still operating. So that means he gets to have the rest of the lease for the next 2 years, even though the farmer wasn't paid. So you might want to put a clause in your lease that that lease is expired if the guy doesn't pay rent.
Oh, wow.
Yeah, think about that. So now we're going to wrap up here with farm business structure. Sole proprietorships, partnerships, corporations, LLCs. Which one is best for you? Well, it depends. Do you have different owners? Are you going to be working into an organization that has multiple owners? Do you want to have different decision making and management flexibility? How's the profits going to be shared? How's the taxes going to be dispersed? Is limiting liability a major concern? Are you doing this to ease the transfer of business property? You know, transferring, I think I'm going to give you $13,000 worth of land each year. How am I going to give you $13,000 worth of land? Are we going to go and subdivide each year $13,000 worth of land? Well, we can't hardly do that because the land's on one deed. But if we put the farm into an LLC, I can transfer $13,000 worth of ownership of the LLC every year. And that way we can do that. And what is the lifetime of this business? Sole proprietorship, you own it. You have the responsible for the debts. You have unlimited personal liability. You file on your 1040. Take it on your, fill out your Schedule F. It goes to your 1040. Pretty simple. Most of us are that. Partnerships. 2 or more people join together. Stick your hand out, Kyle. We're in business. Unfortunately, that's the way a lot of partnerships are done, and they don't include, well, how are we going to get out of this business? What if you want to leave? What if I want to leave? What if I get killed? Do you want to be in business with my wife? Does my wife want to be in business with you? I don't want to be in business with your wife. If you get, oh boy, we didn't think about that, did we? And those are a lot of things. I'm responsible for anything you do for the partnership. Worse yet, you're responsible for anything I do for the partnership. I can trust you, you can't trust me. Oh my goodness. And whenever you file your taxes, you file Form 10 Schedule F, it goes on to Form 1065, and that splits the taxes and our income between the two of us. You pay your taxes and I pay my taxes. But that liability, isn't that a little worrisome? Yeah. Well, then there's a such thing as called a limited partnership. We actually have an agreement. We have a general partner that manages and controls the day-to-day operations of the business. We have limited partners. They're not actively involved. They still have some liability though, but they're treated as outside investors. Why would we want to do something like this? We might have some limited partners, like we want to, instead of way to treat our off-farm heirs, what we can do is we can give them limited partner share. They don't have a say in the run of the business, but if the business is to be sold, or particularly the real estate, they still get their share. So that might be a way to go. Now, we see a number of corporations out there in farms. Very few today. Corporations like same as Ford or GM. The corporation owns all the assets, operates the business, doesn't have dependents, enters into contracts, pays taxes on the dividends, and then the stockholders' liability is limited to their investment in the corporation. There's a hybrid called an S corporation, and the main thing here is there's limited to one class of stock and 100 or fewer shareholders, but the profits here, the S corporation does not pay a tax. The tax income flows through to the shareholders, and they report that as self-employed income then. So that way there's not double taxation on it. Now, the complications of corporations are that there's double taxing of C corporations, and there's only one class of stock for S corporations, meaning everybody has to be kind of like an equal owner. Don't ever put land into a corporation. Can you tell us why, Lori?
Well, because you pay tax on the appreciated value.
Yeah. If you own a farm and you put it into a corporation, and after 3 years you decide, even though I'm the whole stockholder, if I decide to dissolve the corporation, guess what? I have to pay tax on bringing the land back to sole ownership. So don't ever put land into a corporation. You're going to be paying capital gains tax. Now, lawyers got together and they walked around Lancaster County, Pennsylvania, and they saw these mules. They found out they were a hybrid. It had some of the strength of a horse and some of the durability of a donkey, and go, this is a pretty good hybrid. I wonder if we can do something like that with a legal structure. So they got together and they bred a corporation and a partnership and came up with this thing called an LLC. So it's regulated under state law. It contains the limited liability for ownership with the flexibility of what's called the flow through tax provisions of a partnership. So you get to pay the taxes as a sole proprietorship, but it has a limited liability. And whenever you break it up, you get to have your share of it without having to pay capital gains tax. Fantastic. And you imagine what they can do with GMO breeding these days? Well, this thing is the most popular thing of most businesses doing today. You form an LLC. Okay, you have a highly flexible document for your owner's operating agreement. Allows members to tailor their operations to meet the personal needs according to state law. The advantage of that is the operating agreement. The disadvantage of it is it has a highly flexible operating agreement. Magical LLC. Well, we talk about this liability. It doesn't prevent you from being sued. You still need liability insurance. The other aspect of it is there's some of this idea of limited financial liability. Because the first things you can think about is, I know what I'll do. I'll put all the debts in the name of the LLC, but I'm going to keep the farmland as sole proprietorship. Well, you know, bankers aren't real smart, but they're not that dumb. They're not going to allow you to do that. So that's not going to work quite as well. Now, how could we do this? We'll set up the farm business as an LLC. The LLC owns all the inventory involved with the business. Their inventory, the equipment, the graders, the vegetable containers, and they can lease the real estate from mom and dad then. Who's in the LLC? Are the farming parents and the farming children. And then the idea of it is, while the LLC is operating as a business, the parents gradually transfer control of the farm business within the LLC as defined within terms of their operating agreement. So they transfer ownership shares either by sweat equity, gifts, or wages and sales, or a combination of all the above. The end result is that whereas we might start out with 10% ownership by the kids and 90% by the parents, within a 7-year period we might shift this around so that the kids own 90% and the parents own 10%. Now, why don't we just do the same thing with the land? We can set up the farm as a LLC. An agreement defines the different ownership classes, and we're going to define some. We're going to have some owners that have a role of ownership, but they have no role in active management. So we have a plan to distribute the assets of the farm, again, by either gift, sale, or inheritance, combination. The farming LLC, the farm business, which is now owned by Kyle, he has a long-term lease on the real estate, maybe 20 or 30 years. So he knows he has the real estate, so it allows the farming LLCs will have the real estate management role, but the off-farm heirs will end up with some ownership share, but they have no authority or say over the farm is going to be used. But if the farm is ever going to be sold, they will still get some of those assets at that time. And the farming heirs, this is essential. The people that are operating the farm must have control of the farmland if they're to have any chance of success. I got 3 more slides here. I'm holding you up from lunch here. Big concern is health care. Well, you can die before your long-term care. That's the best plan. Well, we don't know how to do that. Well, we can finance it with our own out-of-pocket cash. Well, that's difficult to do too. The children will take care of us. I'm not so sure. Long-term care insurance. So, no, wait a minute. If I buy long-term care insurance, then I can protect the farm, but the only way I can afford long-term care insurance is by selling the farm. Boy, that doesn't sound like a circle. How about Medicare or Medicaid? They'll take care of it. Well, let's see, self-financing. The fear of most farmers is, do I have to sell the farm in case I have to go into a nursing home? That's a huge problem. Although most farms, if you qualify for Medicaid, you're allowed to keep your homestead, which a farm will qualify if it's a continuous deed, I believe. And that varies from state to state. And there's also a maximum value on it. Medicare ain't going to pay much. That's the bottom line there. It pays for a very small amount. Medicaid, we're going to let the government pay for it. Well, you got to be 65 or over, but it's this part here. What is the financial picture on your application date and your income? Whoa, this gets a little complicated here because individuals are going to have to pay most of their income to the nursing home. Spousal income is not counted, and other requirements vary from state to state. Now, one of the things that we have found with the states that I've been involved with is most of them do not like to break up a business to sell business assets to pay for someone's care in a nursing home because that ends up putting a business that employs other people out of business. And so whenever you get, it might be advisable to have some of your assets tied up in an LLC that's operating a farm business so that those assets may not be considered. This gets very complicated, and the advice in the state of Vermont has always been it depends on the caseworker that you get for your application because these rules are constantly changing. So I'm not going to make any general statements on it. If you are to thinking and you're concerned about how to target your assets for involvement in estate planning, one of the things you need to do is probably see an attorney, but not just see any attorney, you need to see an elder care attorney. So here's a website that I have, www. Farm transfer, where I've got a set of farm transfer videos. And one thing that I forgot to do, I forgot to hand out over this that has that on. And what this website has on, I have about 18 different topics on here that you can click on. Each of these are like 5 to 7 minutes. And so you can, if you have somebody at home that can access a computer, they can look at these. I have 3 case studies. I'm going to have 2 up there very shortly. One here on family farm business agreements. There's several on taxes. How does the LLC compare to a partnership? How does the difference between a trust and a will? So that there's a lot of things on here that you can look at and gain advantage as you're doing some estate planning. Okay, medical steps you also need to do. Have a living will, healthcare directive, and be remembered to see an elder care attorney if that's your primary thing. Okay, I also even have, you can actually go through a workshop like this that I have on there. Now, so you got to communicate with your family. You cringe right away. And that's the first step that a lot of people have a lot of big problem with. You got to get the people into a room. Seek advice from others. Come to workshops like this. Talk to other people today in the room. What are they doing? Talk to specialists. You need to know your legal specialists, your accountants that tell you the tax perspectives on things. You have to develop a plan, because if you don't make a plan, you're going to be planning not to make a plan. And then there's this big step here that's the hardest. What is the most difficult step?
First one.
You have to stop procrastinating and set a plan in motion.
Do it. Just do it.
You have to do it.